Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the things I'm seeing in the market as a great opportunity is buying companies that are actually buying back a lot of their own stock. The market really seems to be interested in growth stocks again and is sort of overlooking companies that are generating a ton of cash and are just using that cash to buy back shares like crazy. So I have 4 stocks today that I want to cover that are buying back a lot of their own stock. And I think that will continue for the next 5 to 10 years, could add a lot of value for shareholders. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to thank today's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. Got a link to that in the show notes, as well as on the screen below. The first company that I want to talk about, maybe a little bit of a surprise, but that is MGM Resorts. This is a company that's known for having multi-billion-dollar casinos in Las Vegas, has a big presence in Macau, and the company's gone through a number of different strategic changes over the last decade, selling most of its real estate to REITs. That has generated cash that the company has used to pay down debt and also buy back shares. At the same time, we're seeing record revenue in Las Vegas. This is a little bit counterintuitive, but actually coming out of the pandemic, Las Vegas recovered to an even higher point than we had before the pandemic. We're also now starting to see Macau recover, and that means that there could be hundreds of millions of dollars in Macau being churned out by that business and being paid in the form of a dividend back to the parent company. And the pace of buybacks from MGM is really impressive. In 2017, the company had 575 million shares outstanding. That is down to 350 million shares outstanding right now. And cash flow from the business is over $1 billion per year. There's not a lot of debt on the balance sheet. There's optionality in things like online gaming, and the market cap is under $13 billion right now. So we could see MGM continue to buy back 5 to 10% of its shares each year over the next decade. And this is while continuing to invest in the business. This is a company that's going to have a 40% stake in one of the few casinos in Japan when that's open, probably later this decade or early next decade. So that could be another money machine for MGM Resorts. This has really become a cash flow company. It's not just a gambling company, partly because there's not a lot of new places to build casinos. So yes, it costs billions of dollars, even up to $10 billion to build a new resort and casino. They're not building a lot of those anymore. Japan is one, but that's a massive opportunity. But they're not building a lot of casinos in places like Las Vegas and Macau. Supply is basically set. And so the industry, including MGM Resorts, is starting to become a cash flow industry. The second company I want to go over is RH, the old Restoration Hardware. And this is a company that's kind of been all over the map with its buybacks. But going back to 2017, the company had 41 million shares outstanding. That's down to just 18.4 million. Recently, management has been buying back shares like crazy. You can see that free cash flow is over $250 million per year. And with a market cap of under $5 billion, the company can buy back a big chunk of stock each year just with the cash that's being churned out of the business. Now, it's very possible that a high-end business like this could go through a downturn and cash flow turns south. But historically, RH has been very successful in being a high cash flow business. And one of the things that they've done with that cash over the last 5 or 6 years is buy back a lot of stock. So if you're interested in this furniture business and the high-end products that they make, this could be a great way to invest in that segment in a company that's buying back just a ton of stock right now. Another one that I think is very interesting is Valvoline. This is another one of the companies that has really sold off because investors just aren't excited about the growth prospects for companies that are investing in essentially legacy transportation, legacy vehicles. This is not an electric vehicle company. That's where a lot of the growth and high multiples come from. This is going to be a company that is servicing non-electric vehicles. So maybe not the same growth, but what do you do with the cash that you're generating from the business? Well, you can buy back stock. And in 2017, the company had 205 million shares outstanding. Right now, that is down to about 138 million shares outstanding. And the company is trading in a fairly attractive multiple, $4.5 billion market cap, price to earnings multiple on a next 12-month basis of about 20. And this sounds a little counterintuitive, but I think this is the kind of business that can actually increase prices and grow cash flow over time. Yes, this is effectively a dying business over the next, let's say, 30 or 40 years. But that doesn't mean that a company like Valvoline isn't going to be making a lot of cash in the meantime. There isn't a lot of new investment in things like oil change stations because all that growth is going into electric vehicles, but there's still a lot of demand. A vast majority of vehicles sold in the US are still internal combustion engine vehicles. So there's still going to be demand for their products for the foreseeable future. I think that means they can just continue buying back stock. It's a little bit like Altria in the way that, smoking was a dying business 30 years ago, but they've just continued to buy back stock. They have a relatively low multiple. If you're buying back stock at a low multiple, you can add a lot of value to shareholders just by reducing that share count. So that's what I see from Valvoline, who has gotten very aggressive in buying back shares. And the final stock today is Avis Budget. This is another one of these companies that I think is just in a very attractive supply demand market. Rental cars are not readily available right now. That means they're very high priced. Margins are, as a result, very high. There's also limited supply in a lot of the locations that they're operating in. This is just a recipe for a ton of cash flow coming from the business. And what have they done with that cash? Well, they've been buying back stock. The current market cap is $7 billion, but you can see here that over the last 10 years, the shares outstanding have dropped by nearly 70% as the company has bought back a ton of its own shares. And while free cash flow is volatile, I think there are a lot of tailwinds behind a company like this just because of that supply demand dynamic. The reason that rental cars are so expensive is because they're in high demand. And with the current shutdown in production in Detroit and a continuation of high prices for both new and used vehicles, I think the market dynamics for a company like Avis Budget are just very strong over the next 5 to 10 years. If they continue to buy back stock at this rate, we could see another half of the current shares outstanding bought back in the next decade. But what do you think about these four stocks and the rate at which they're buying back stock? As a reminder, I went through MGM, RH, Valvoline, and Avis Budget. Which one of those is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.